Hi, my name is Rhea Zhou, and this is my research on quantifying biopharma alliance fragility using the Strategic Shock Risk Index, or the SSRI. Every year, biopharma alliances drive billions of dollars in drug development, but many collapse before completion. When that happens, share prices crash, timelines slip, and worst of all, patients lose access to promising therapies. Yet, there's no early warning system to predict how severe a breakdown will be. Seeing that gap led me to create the SSRI, a data-driven model using deal characteristics, development stage, and dependency metrics to forecast the market shock that a termination would trigger. Think of it as a risk thermometer for alliances. It tells you whether you're facing a mild dip or a severe crash. To build the SSRI, I compiled a pilot dataset of 20 terminated alliances between 2014 and 2024, using SEC filings, press releases from sources like Fierce Biotech, and PubMed. For each deal, I extracted key features such as deal size, duration, phase of development, unilateral exit rights, which indicates whether one party can walk away, and concurrent alliances to measure portfolio diversification. I then standardized these features using min-max normalization and binary encoding before running a quadratic regression with interaction terms to account for nonlinear patterns. So over here, I have this computational handbook, which is meant to guide you through the various techniques used to develop the SSRI. I'll summarize and break down each one quickly so you can follow along, starting with PCA, or Principal Component Analysis. I chose to use this technique because I had many related variables, like duration and strategic fit, which all fall under the company's overall dependency on their partner, and prior terminations and concurrent alliances, which all are factors of diversification. And so by using PCA, I was able to compress these related variables into a smaller set of summary scores, dependency and buffer subindices, to capture most of the variation. Secondly, I used OLS, or ordinary least squares regression, to build the actual SSRI, because I needed a predictive formula linking pre-termination features to severity of the market shock. So, I set up the model to be normalized abnormal return equal to individual features like deal size and these different subindices mentioned earlier times their weights. I added interaction terms like duration squared and duration times the dependency to capture nonlinear effects. OLS was used to solve for the coefficients or the weights for each variable to minimize the sum of squared errors between predicted and actual NAR. The output was the SSRI formula, an interpretable equation where each coefficient shows both directions, so positive or negative, and strength of effect, which is the magnitude or the actual quantity. So now it's a good time for me to break down what the NAR is, normalized abnormal return. I employed an event study with Python's library yfinance to build the target variable, the NAR, because I needed a quantitative measure of market shock for each termination event. I first downloaded 60 days of stock prices for each early-stage biotech company and the S&P 500 around the termination date. I then computed the daily returns and abnormal returns. To get the cumulative abnormal return, I simply summed the abnormal returns for days t equals -1, 0, and +1 around announcement, and then I applied min-max normalization across these different quantities to compare across alliances with different volatilities. Finally, I needed to measure the model's actual performance and fit, so I first used the R-squared metric to see how well my regression actually explains real-world variation and market reactions. I first computed the variation of actual NAR values around their mean, and then the variation of model errors, which is predicted minus actual. I calculated R-squared using 1 minus the residual variance over the total variance. Beyond predicting how big the shock will be, I also wanted to test if SSRI can really flag which alliances are high risk. So I employed a classification model called the ROC curve and measured the AUC, which is the area under the curve, to test this. I defined positive cases as painful terminations having an NAR greater than 0.75. I swept through all of the possible cutoffs for the SSRI and calculated the true positive rate and false positive rate, which are the fraction of real painful terminations flagged and the fraction of stable deals wrongly flagged, respectively. I plotted a curve of TPR versus FPR and calculated the area under this curve, which indicates the probability that my model ranks a random painful alliance higher than a random safe one. As you can see, the model performed very strongly. R-squared equals 0.82, which means we can explain over 80% of the variance and market shock. And the AUC equals 0.96, which means we can almost perfectly separate high-impact breakdowns from mild ones. This means that 96% of the time, the model correctly ranks a high-shock alliance above a low-shock one. If you look here on the poster, you'll see that most points lie right along the diagonal, confirming our predicted versus actual shocks are closely aligned. And this distribution plot shows most alliances have moderate shocks, but a few severe outliers, which SSRI is able to flag in advance. This scatter plot of the SSRI versus the phase of development shows that early stage alliances mostly have similar and moderate fragility, while later stage alliances tend to be more spread out, which makes sense because late stage deals involve more money and higher stakes, so investors react strongly when they break. Lastly, this 3D surface plot of duration times dependency shows that fragility peaks when alliances are long and moderately dependent. This makes sense because if dependency is extremely high, markets seem to already expect failure, so the shock is smaller. This tool has real-world implications. Founders can build smarter stage gates and reversion clauses into contracts, investors can price milestones more rationally and avoid hidden risks, and business development teams can design more resilient option-based multi-program deals. Looking ahead, I've expanded the dataset to over 240 alliances with the help of Mark Edwards, founder of BioSciDB. I'm also incorporating richer firm-level buffers like portfolio concurrency and mining press releases and SEC filings for governance and strategic fit signals. So, in short, SSRI is a first step toward predictive alliance risk modeling. By quantifying fragility, we can help companies avoid costly surprises and ultimately get therapies to patients faster. Thank you for your time, and I'd love to hear your feedback and questions.